We're delighted to have Mark Mahaney on the show today. Mark is Senior Managing Director and Head of Internet Research at Evercore ISI. He's been Institutional Investor's #1 Internet Analyst 5 times. He frequently appears on CNBC, Bloomberg TV, and Fox Business, and is often quoted in the financial press. Earlier in his career, he was a Managing Director at the Royal Bank of Canada and Citigroup. Mark holds an MBA from the Wharton School, an MA in Economics from Johns Hopkins, and a BA in History and Political Science from Amherst College. Mark, it's been a whole year since we've had you on the show. Our viewers have been waiting for your return, and we really wanted to hear you discuss the outlook for 2026.
Well, it's been a very eventful year, and I'm happy to be back here doing it again.
Well, it seems like it's already been a very eventful month as 2026 goes. I wanted to ask you, in a recent CNBC interview, you mentioned that the AI rally is going to continue through this year and the next. And I guess in the latter quarter or so of the year, there was some concern about this, virtuous turn vicious cycle where the names like Nvidia are investing in their customers so their customers can afford to buy their chips. So I think there's some questions about that AI trade. Given that and your thoughts on how AI will do, is this a good time to add exposure to the sector in names like the hyperscalers or like the infrastructure firms?
Well, I always like to be careful with the broad-based statements about investing in stocks. I try to be relatively selective. But some of the stocks that I most like here, names like Amazon, Meta, I still like Google, even despite the material run it's had, but it's further down my buy list. All of them are levered in some way or another or very strongly to the AI trade. And I think one of the most interesting data points we've gotten in the last year just came from Meta's earnings 2 nights ago, when they are clearly leaning aggressively into investments. CapEx doubled in 25, almost doubling again in 26, up to 130, 135 billion. But you're seeing the returns. Like what we know that the spend is there. We've been waiting to see whether we would see an ROAI, ROI, ROAI. And the answer is yes. At one of the biggest deployments of AI out there, this is across all of Meta's properties, Facebook, Instagram, WhatsApp. This company is able to use AI to both increase engagement, the amount of time that each of us spends with its properties, Facebook, Instagram, and WhatsApp, also Threads. But also it's able to increase the effectiveness of ad campaigns on those properties, on those brands. And it's showing up in the numbers. This company is guiding to something like 30% year over year revenue growth in the March quarter. Let me put some context around that. The last time they grew that fast was 4 years ago when the company was half of its size. And it was a sizable company back then, and it's even more sizable now. So you rarely see something like that. And I think it just speaks volumes for how powerful the impact of AI can be on business models when companies execute really well. So I just look at us as having received a really powerful ROAI data point. Yes, I think AI is an investable thesis. I think it actually improves efficiencies. It doesn't just bring down costs. It improves efficiencies. It improves products. It improves processes, and it's leading to positive revenue results for the companies that are most successful with it. And if you can find those companies, especially if there's any, especially when they're dislocated, then you want to be leaning into them.
Right, right. You bring up an interesting point. Meta had earnings and up 10%. The same day, Microsoft absolutely gets spanked. They're spending a lot of money, but there seems to be concerns on whether or not they're growing fast enough to justify that. Is that that dichotomy justified? That Meta's up 10% on the day, Microsoft's down 10% on the day.
Well, I don't formally cover Microsoft. I just think these are very different setups, and Microsoft also is two different houses. There's the clear AI beneficiary, which is Azure, their cloud services business. But then the rest of Microsoft is software, as you know, and the entire software sector has been under enormous pressure from AI, under the belief that AI is going to cause both pricing and units pressure. Pricing, if you're charging a premium for your productivity software in an age of AI, your ability to maintain that premium is going to be thoroughly challenged. You may succeed, but it's going to be challenged. Units. If AI is really bringing the productivity improvements that we're all talking about, Zuckerberg on the Meta call said that they were seeing 30% improvement in their productivity per engineer. That means you probably need to hire fewer engineers. That means those companies that are selling software on a per seat license, there may be fewer seats to sell to. So I've oversimplified the software trade, the trade down. But to me, it's AI is coming in, it's pressuring ARPU, and it's pressuring unit growth, the two basic drivers of software models, and hence the sell-off. And Microsoft is kind of in the middle of both of these worlds. It's both. I mean, that's the simple amongst tech companies. The great divide right now is whether you're an AI winner and an AI loser. Doesn't mean the market's right. The market's got a few things. It's going to run one way or run another way. The market 9 months ago was certain that Google at 15 times earnings was an AI loser. Today, Google is at 30 times earnings, and the market is certain that it's an AI winner. And the truth is, it's probably somewhere in between.
It's really amazing. They came, you're absolutely right. They came, they rose like a phoenix on the ashes on Gemini 3, I think it was, and people thought that was really good.
Yes.
And all of a sudden they were horribly in disfavor, and everybody turned their heads around. And
Yes.
what do we think when we see Gemini 4?
Like if we think about one of the most interesting, I think the single most interesting stock move of the last 12 months has been what happened to Google in terms of, the stock more than doubled off of its lows, and the multiple did double. It went from 15 to 30 times earnings. It did. What's the why? Why did it do that? And then what are the implications as a stock picker? And the why is that the narrative changed from it being, a company. Well, there was a lot of other things to the narrative too. They were going through the DOJ case, the monopoly trial, but there was the broad consensus that it was going to be disrupted by AI, especially by ChatGPT. And now that's changed dramatically, largely through some product innovation. And so I step back and I think about it as, stocks can change when the key narrative changes. I am looking at stock picking in 2026. I'm looking for stocks where I think the market's wrong on the AI narrative, that it's a company that the market thinks is going to be disrupted, negatively impacted by AI, and I think it's going to be positively benefited by AI. So that leads me to my top pick in the internet space, which is Amazon.
Right, right. And Amazon, I think you had recently said that Amazon was your top tech pick for
Yes.
2026, and you liked their entry point, and you felt they've underperformed. Why is Amazon such your top pick?
Okay, so yeah, let me. I think let me. Here's the setup. I think the market believes that the market is uncertain whether AWS is disrupted or disrupted by AI or benefits from AI. I think it's more the latter. I think they're just seeing more demand. I think you're at an inflection point with AWS growth. Last quarter, the revenue growth surprised people. Went from 17% year over year to 20% year over year. I think you're in a cycle now where you're going to see accelerating AWS growth for several quarters. If I'm right about that, that's a high margin business for Amazon. It's very beneficial to its overall margins. On top of that, I think the retail business is likely to accelerate this year too. Oh, in the US, there's the big, beautiful bill tax rebate checks that a lot of US citizens are going to get. That's a small factor. I think there's also an AI factor. Now, I think the retail business, Amazon's core retail business, is getting better because of AI, not only on the cost side, and I'm thinking about robotization kind of across their distribution centers, across their fulfillment centers, but I mean in terms of this new agent called Rufus, and I think they'll integrate this into the core shopping experience, but that is just much better. It creates a personalized, iterative, interactive shopping experience to help you find that perfect gift for your wife at Valentine's Day, or those perfect gifts for your children, at their birthdays. Or at Christmas, I've been experimenting with this. We've done a couple of reports on it. So I just think that the shopping experience is improving. I think you're starting to see the rise of agentic commerce, and I think agentic commerce is coming, and it's coming to Amazon and other places too. But I think you're going to see Amazon as one of the biggest beneficiaries of that. And then the final element. So I think Amazon has got accelerating cloud growth in 26. accelerating retail growth in 26. Also, they have a new, much bigger push into groceries, which is a key kind of missing area, I think, for Amazon, or they've underpunched in that area for a long time. And then the third part of the Amazon outlook for this year is advertising revenue. And advertising revenue, I think, is also going to accelerate. It usually ties in with retail anyway, but there's a lot more inventory that the company has as they do a lot more live sports programming. So I just like the setup. If you tell me there's a company that's going to do accelerating revenue growth and expanding operating margins and has been a dislocated stock, my response would be that sounds like a stock that's going to do really well. And I think that's I think the setup on Amazon is exactly that. So that's why it's our number one pick.
So definitely don't sleep on Amazon. It's a very good point about using Rufus because how good is Meta at using the driving eyeballs to like, oh, you like watches, we're going to show you what they show me watches all the time. I don't want to see watches all the time, but they're good at that. And Google the same way. And if Amazon can jump onto that, it makes a lot of sense. Along with Amazon, you've picked Expedia and Zillow as a couple of your top tech picks. They're kind of very different businesses. Briefly expand on why you like Expedia and Zillow so much?
Yeah. So, and these are, and I'm being very tactical with these calls, but that's what my job is. So, Zillow, and one, you do have very reasonable valuation. It trades at 18 times GAAP earnings. It's got a good financial model, generates a lot of free cash flow. They buy back stock, they pay a dividend. So, it's a good online travel is a good sector to be in. The dirty secret behind the wonderful economics of online travel is it's a thoroughly fragmented supplier base. And basic economics, the more supply there is, the better for the network or the intermediary or the retailer in the middle. But what's also interesting to me about Expedia is that we've had a management, I think, upgrade. We've had a new CEO in place for almost 2 years now, and she actually ran one of their business units, I think the most successful of their business units for 8 years prior to that. So I think you've got a really good operator as CEO now. You got a relatively new CFO in place too. He came from eBay. And you've got this particular advantage that the company has this year in 2026 as a U.S. travel company. And here's the setup. Last year, we had softness in U.S. travel sales in the middle of the year, given all of the kind of economic uncertainty in the wake of the Liberation Day tariff announcements. And then you also had a little bit of a boycott of Europeans and Canadians, two of the biggest travelers into the U.S. There's a little bit of a boycott there. Third is with the government shutdown for a good period of time at the end of last year. I think that kind of negatively impacted travel demand. And then I go into this year, and I think some of these tax rebate checks that they're going to be sent out to U.S. taxpayers. Although I worry that we're going to get back into the stimulus game, and that's going to lead to inflation. I do worry about that. But I also understand near term that people get a $1,500 check. They're probably more likely to travel. And finally, the big global event that we're all waiting for this year is the World Cup. And the World Cup is in North America. And the World Cup is the biggest World Cup ever in terms of the total number of teams that are participating, the total number of games, the total number of days of the World Cup tournament. And it's primarily in the U.S., but there are also some games in Canada and in Mexico. And so I think you're going to see a surge. There is a surge in demand. I mean, you're seeing record high prices for these tickets. And I think that's going to help the travel company that's most levered to the U.S. market, and that's Expedia. So that's my pitch on Expedia. Good business, very reasonable valuation, upgraded management team, and then a very specific positive play off of what I think are going to be very strong U.S. travel trends this year.
And then Zillow is the little bit, briefly, if you could talk about why you like
I'll
that.
be very quick with Brazil. If this is a mid cap play, so any of these mid cap plays less than 20 billion are always more speculative, almost by nature. But I think if you get any sort of signs of a housing recovery, this is one way to play it. There's a good product cycle here. They've got some new features, something called showcase listings that I particularly like. This company now has finally reached, after 10 years, GAAP profitability, and I think it's sustainable. By the way, with now being GAAP profitable, they could be considered for inclusion in the S&P 500. There's a series of legal issues hanging over the company. I think as those get addressed, most scenarios that I can work through have those serving as relief catalysts. I think the stock trades up on the resolution of some of these legal issues. And then just in terms of the numbers, this company is going to be exiting exited 25 with 19, 20% top line growth. Comps get easier in the first half of 26. And if we get any signs that mortgage rates come below 6% and you get an unlock in the U.S. housing market, I think Zillow could be a great beneficiary of that stock wise, fundamentals wise. So it's our top mid cap pick.
Sounds good. Sounds good. So it sounds like you love Amazon. It's a great idea about the World Cup. It's like having the Super Bowl, the World Super
Yes.
Bowl in the U.S. That's a very good way of thinking about it. And Zillow could be a good mid cap pick. On the subject of mid caps, there are a lot of folks who say that sort of big caps have had an amazing run of, pulled the S&P up for years and years and years, and the Mag 7 or the Mag 6, whatever, what have you. It's time to rotate out and go into more of the mid, or maybe even the mid, or even the small caps. What do you think of that thesis? Will the big boys still be leading in 2026 as they have had so long, or should we be seriously considering a little bit of sort of size rotation?
It's a very good question. I'm not sure I've got a great answer for you. I don't spend as much time thinking about the size, the cap size of what should be in the portfolio. I'm just looking for high quality assets, and ideally, this was in my book. I look for what I call DHQs, dislocated high quality companies. That was Google last year.
Hmm.
I think actually in the small cap space, I think it's Zillow right now. Stock has had something like a 30% correction recently, mostly due to these legal headlines, and a little bit of uncertainty over the U.S. housing market. So now if I find a high quality asset that I think is dislocated, I want to lean in on that. And so I don't see any particular reason to shift away from mega cap to small cap. But I see a good reason to have a balanced portfolio that includes some mega cap names. And if you can find some high quality names, and it's tougher to do in small cap. Most companies are small cap for a reason. Their TAMs aren't their total addressable markets just aren't as big, or there's a variety of different reasons, or it's more competitive space, what have you. But I do think that there's a couple of interesting quality names in mid cap, and Zillow's at the top of my shopping list.
Got it. And I'm not sure if you cover Tesla as a name, but our viewers, so many of our viewers are interested. And I guess it seems that Tesla is now moving away from Elon. Once the emphasis is no longer cars, it's really space in a way, and really it's robotics. Is robotics, is there a great future for AI in robotics? I mean, having a robot in my house, I'll be honest, that sounds a little strange to me. But he seems to be wanting to, manufacture these en masse in the next couple of years.
Well, I've always thought about robotics as the physical manifestation of AI. Maybe I'm right thinking that way. Maybe I'm wrong, but I do think about it that way. By the way, it's another reason I like Amazon. I think the largest deployer and largest employer of robots is likely Amazon. I think they have over 1 million, robots. Now, these are defined a little. Sometimes those little small circular Kiva units that you stack books on top of them and they roam around, the factory floor. So, not all robots look like, what we've seen in the movies. But anyway, I think, I think you'll see more and more robotization. I think you'll see them increasingly in households, but this is like a 10 to 20-year journey
Right. Right.
for most people. I'm just struck. There's something else actually. You reminded me, personal intelligence.
Mhm.
Apple is promising to come out with personal intelligence. Meta is saying that one of the reasons they're investing so aggressively is that they want to create personal intelligence. And Google Gemini is now, just for the last week, at least I've been able to test it out. They have their own Gemini personal intelligence. And I think this is where I think in the next 3 to 5 years, I think most of us are going to have like a digital agent, like an assistant, digital assistant that just can help you perform tasks better than you can do now, where you can just turn to your agent and say, please put in my calendar all of the World Cup games, and what time they're going to be on the TV, and what station, and put it in my calendar rather than or and I'll stick with the World Cup, and I want to go to San Francisco because I really want to watch a team from South Korea play. I don't know if they're playing in San Francisco or not, but I'm pretty certain they're in the World Cup, and I want to catch their games. Oh, by the way, how much would it cost me to take my family to San Francisco to watch, and, we'll turn it into a family vacation. I would need a hotel, a rental car, flights, like an agent that could put together packages quickly for you. And when you say, yes, book that for me, that would book it for you. We're not there yet, but I think that's exactly where personal intelligence is going to take us. And I don't think that's 10 years out. Robots in all of our houses 10 years out plus. Digital agents that do that perform those kind of tasks for us 3 years out. And I may be too long in doing that. And I think, we're going to refer to these as personal digital assistants. And I think it's going to be, I think it's going to unleash another wave of kind of productivity and revenue growth acceleration.
That's a really good point. I haven't quite heard it characterized that as personal agents, but it would seem that Google, with its tentacles into everybody's lives, may be very, very well poised to do that. I use Perplexity as an AI, and Perplexity came up with this Comet browser. I think exactly as you sort of described. I didn't just put two and two together until you mentioned it. I'm not using a Comet browser because it does funny things to my system, but that looks like a really interesting sort of maybe a I don't know if you'd call it a DHQ, a displaced high quality name, but that's something to think about that perhaps a lot of people aren't thinking about. Taking a little bit of a step back, a lot of discussion of with AI and how powerful it is, and you mentioned that software companies might be buying fewer licenses because AI is making programmers so much more efficient. There'll be fewer programmers. Do you sense that if we are seeing it now, we'll see more of it, a disruption of sort of humans would suddenly programmers who always had work now increasingly are struggling. Do you see that I guess phenomena or coming more to the fore in say this year, in terms of AI actually displacing more people? I mean, Amazon just announced another, sort of 16,000 layoffs. What do you see on that front?
That's a really profound question. My guess is that it won't displace. No, it'll displace employees for sure. I don't think it's going to lead to a net reduction in employees. I don't think that's what's going to happen. By the way, if you start looking at the largest companies, actually, I don't know what Microsoft is doing, but I look at Meta, Google, Amazon, net, especially Google and Meta, they are hiring. Like now they're, shutting down parts of reality labs and actually hiring more people into their AI groups. Yeah, I don't. There's this thesis out there that big tech is an AI is causing big tech to reduce jobs. I don't think that's true. We went through these cycles. So we had this huge hiring spur during COVID because there was a belief that we had this permanent change in the growth outlooks, and it turns out we didn't. So then you had this pretty material layoffs out of big tech in 22, 23. And then 24 was kind of getting back to par, not much growth. But in 25 and 26, we're doing kind of solid mid-single digit percent growth in these companies' employee bases. I'm going to make these numbers up, but I'm not that far off. I think Meta now has about 80,000 employees, and they're growing about 6% year over year. That number may be a little higher than what I gave, but the growth rate is correct. And these are big companies, and I think they're still hiring. And so I think my only takeaway, what I tell my kids is, yeah, learn AI. Like spend as much time as you can ramping up on AI coding skills and watching videos about AI. Just try to become intuitive with it and look at it as a productivity tool. Just like 30 years ago, you would have said you got to learn how to use a computer. And 15 years ago, like get a smartphone and really figure out what it can do, what you can do with it. Same thing now. Download and try out AI tools and see what you can do with them because they are productivity and lifestyle, I don't know, enhancement tools. So I'm sorry, that's a little bit of a side note. I don't agree with the narrative. I may be wrong. I don't agree with the narrative that AI is going to it'll cause changes in growth, just like the rise of the computers did, just like the rise of automobiles did. So these things will cause disruption in the workforce, but I don't think they cause the workforce to decline. I think the workforce continues to grow.
Yeah, I think you're absolutely right. I mean, there's a certain resistance, I think, certainly on the education end. Say, we shouldn't use AI. I think you're right. We should be learning how to use AI to make ourselves more productive. It's like silly. It's sort of don't use a smartphone and don't use a computer. Where would you be? Right. I think you're absolutely right on that. I saw there's an article in the journal that says that OpenAI could be looking to go public as soon as the fourth quarter. They might try to beat Anthropic to the punch. Do you see any of the major IPOs, Anthropic or OpenAI, going on this year? Or are we a little bit too early for that?
I don't know, but I was surprised. The reporting sounded pretty definitive that we're going to see these companies attempt to get into the public markets. You didn't mention the third company, SpaceX. So I think and I don't know whether SpaceX, I've just seen, I had, no inside knowledge on any of this. What I see in the papers is SpaceX may do a merger with XAI. And so we could have three blockbuster IPOs. That statement, I'm sorry, I'm not at all supporting any of these IPOs. I don't have an opinion on them. I don't want to give you the wrong impression. I can just tell you that would there be enormous amount of public interest in these? Yeah, sure there would be. I don't think that's getting out of school by saying that. Whether they are the right investment, at the time of their IPO, that remains dependent on so many different factors. And there's a chance here we may have these companies come public that are still deep in loss mode. That's okay. I talked about that in my book. Uber was a company that I initiated coverage of at the time of the IPO. Spotify was another. Over time, those became very good long-term investments, but they came out not profitable at all, like deep losses in the case of Uber. So you can invest in a company that's generating deep losses. You have to be really careful, though. There's a series of questions you need to ask yourself as an investor as to, when, why, and how they can be profitable, because they all got to be profitable at some point, or else you'll never make money on your investment. So anyway, yeah, my guess is that I step back. I think the overall market conditions are actually pretty positive. I'm sorry, I'm looking at the market, and the S&P 500 multiple is, I don't know if it's at a peak, but it's certainly in the upper half of its robust historical range. That's a good thing for any companies thinking to go. You want to go public when markets are robust, not when they're weak. Second is the macro environment, I think, is relatively resilient. I think that call could have been made a year ago, and I think it'll probably be made a year from now. Now, there's always black swan events that could change things, but for now, the economy seems relatively resilient. And then the third thing is the direction of interest rates, because there was one thing that really spoiled tech, really undermined tech. It was 4 years ago. Like, we are 3.5 years into a major tech bull market. And but right before that started, we had 6 months of gut-wrenching declines in tech markets in the first half of 22 because interest rates skyrocketed. And to me, the tech lesson is, if you think that interest rates are going higher, you want to avoid, or you want to be really careful about long duration, speculative, risk on tech stocks.
That's a very, very good point. And Kevin Warsh, I think he'll blow over, but that was a little bit of a surprise. And, he has a history as a hawk. But you make a very good point there in terms of when a company should go public, especially, it's probably okay if you're not showing any revenue. In some ways, it might be a little scary if you're showing revenue, positive revenue, and it's not what people think it is. You're better off selling hope than selling, revenue in some cases in these IPOs. And you mentioned that very well with Uber.
I just want to be careful. You meant earnings.
So I
Yeah, you
mean,
got to show revenue, but
sure.
you don't have, you don't.
Exactly.
You can invest in companies that aren't generating a profit, but you have to have good reasons for. That this is the exercise I went through when I looked at Spotify, when I looked at Snap, when I looked at Pinterest, and some of these stocks did not perform well. And when I looked at Uber and Lyft, you have to ask yourself fundamental questions like, do you think there's anything structural that'll stop these companies from being profitable with scale? Are there any proxies in the public markets you can say, well, that business model works because I've seen this evidence here? And that's probably an advantage that an OpenAI could have if were they to pursue kind of an ad model, which is what they've now announced they're going to do. We have a good number of ad models in the public markets: Google, Meta, other names like Reddit, AppLovin, and some of these models I just mentioned four that are actually very profitable. So the business model is probably not going to be the risk that investors are going to debate. What investors are probably going to debate is the ability of these companies to really, it's going to be kind of a management question. Like, is this management team good enough to execute quickly enough? That's going to be probably the biggest debate.
It's just taking a step back, because you could argue in some ways that in the 1990s we overbuilt the infrastructure of the internet, and it took some time to really take advantage of that. And similarly in crypto, with names like Ether and Solana, that they overbuild their infrastructure. They're showing some revenue, but not nearly enough to justify the investment so far. Is there some concern about that, where we're spending so much money, a lot in the AI economy, that it's going to take some time for the total addressable market to grow sort of big enough, I guess, in a way, to justify some of the valuations? Is that a concern, that we're overbuilding data centers, we're overbuilding that infrastructure, we can't use it for a number of years?
Well, I just want to be careful. I'm going to probably take the other side of what's implied in your question, and I'll also say that the companies that are investing the most aggressively in in AI. So I'm going to go Google, Meta, Microsoft, Nvidia, maybe Amazon. Meta, no, Meta and Microsoft both trade at a PE multiple that's in line with, and I think Microsoft is now at a PE below the market. Google is trading, like I see Meta trading at like 21 times next year's GAAP earnings. That doesn't strike me as egregious for a company that's probably going to grow revenue this year mid 20s, and then next year probably goes close to 20% with expanding margins. I think Google is trading on next year's numbers more like 25 times, but I just don't. This isn't 100 PE. This isn't 50 PE either. And Nvidia, I believe, is 20s PE multiple. So I don't see this big valuation disconnect, this valuation risk. The question is, if it's there, it's in the private markets. So that's why we're going to have to be really careful when these companies come public, as we do with all companies that come public, and really try to assess what the potential profit level is. But then to the first part of your question about whether we're overbuilding, I invested through, or I thought through, or I analyzed through the first dot-com bubble, and there was clearly a lot of dark fiber laid. Fiber that was laid with the intention that it would eventually be lit up, and it was, but it took a long time. So there was extra investment. What you hear now, and when you hear this from a CFO, and you hear these companies like Meta, like Microsoft, say they are supply constrained, what they're telling you is they have so much demand, they can't get enough GPUs, they can't get enough power to meet up with demand. That's a very bullish indicator. I'm sorry, when you just step back and think about it, like these companies are telling you we have more demand than we can handle. And if only we can get more supply, that should be very constructive. Like I don't invest in energy companies, but geez, or in infrastructure companies, but this would seem to be like your biggest customers, by the way, have tens of billions, hundreds of billions of cash on their balance sheets that run very profitable models. And they're telling you, we would buy more from you. Can you please supply us more? I mean, that's a rare moment in history. And so I don't think we're overbuilding. And, the real bottleneck at the end of the day is probably going to be power. And it's good for us to have more power capacity, assuming it's relatively efficiently done and environmentally thoughtful. I have a very different take on this, which is I hear these companies, the ones with the best balance sheets, pretty much saying that we are supply constraints. We got money here. Can you please supply us the chips and the power and the infrastructure and the servers and the networking equipment? And that's a very good position, I think, for us to be in as an economy. I think it's a very good position for us to be in as a market too, in financial markets. So I know that's a contrarian point of view, but I'm going to say it, and I'm going to stick to it.
Well, you make a very good point. I mean, all these guys are. I mean, I think the S&P, is probably 27 or 20, so around 27 or so, and these guys are right around there, and they have huge margins. They're doing really well, and they actually want more. So, I think that is a very fair, powerful point. Last question. As we're 1 month into what looks like a very exciting year, any message or advice as we invest? The one thing that you want the investors to keep in mind.
Well, I'll just stick with my tagline. I really kind of stick with, don't buy low, sell high. buy high and sell low. No, what I mean by that is you want to buy high quality companies and you want to buy them when they're low. That's what I mean. Buy high, low. And you want to look for high quality and some of these that are AI is one of the biggest trends that we're going through, and you want to find companies that are positive derivatives off that, and you want to find companies that have got good management teams that are addressing large market opportunities, that have got very strong value propositions, i.e., sometimes that's most clear in pricing power, and that have got a really good product innovation track record. I know it's hard things to put together, but look to find high quality companies and just wait for them to get dislocated. They all get dislocated, and this market sells off for this or that reason, and take advantage of that and step in and buy high quality assets. So that's what I want to do. I want to. That's what I'll continue to recommend. And those pitches will come. You had a chance at Google last year. I kind of think you may be getting a chance at Amazon right here. Yeah, so I want to stay invested in a market. I do find that the market does follow fundamentals. As companies get bigger and bigger, the revenue bases get larger. Their earnings potential, their earnings generation gets bigger. Stocks generally rise, assuming valuation is reasonable. And so I want to stick with looking for high quality companies, and especially those that can be good trend, good players, good derivatives, good beneficiaries of the single biggest trend in the market today, which is AI. And but I especially want to be disciplined and find them and wait for them to be dislocated, wait for them to be selling off 20-30% sale, or at the low end of their PE multiple range, or at a discount to their growth, or at a discount to the market. And yeah, I want to step in on those. So I want to keep that discipline going forwards.
That's great advice. Well, Mark, thank you so much for spending so much time with us
Thank
today.
you.
Look forward to having you on the show again.